Ever wondered why you can't just insure anything and everything that catches your fancy? Well, there's a legal principle that governs this. It's called insurable interest. But what exactly is it, and how does one acquire it? Let's dive in. Insurable interest is a fundamental concept in insurance law. In simple terms, it refers to a legally recognized relationship between the insured and the potential financial loss the insured might suffer. It's the very thing that separates insurance from mere gambling. So, how does one acquire insurable interest? By stepping into 5 key roles. Firstly, through ownership or joint ownership. Owning a house, a car, or a piece of valuable artwork, for example, gives you an insurable interest because you'd suffer a financial loss if they were damaged or destroyed. Joint ownership operates on the same principle. If you co-own a property, you both stand to lose if something happens to it, thus you both have an insurable interest. Secondly, mortgages also acquire insurable interest. If you've lent money for someone to buy a house and they've used that house as collateral, you've got an insurable interest in that property. Why? Because if anything happens to the house, you stand to lose the money you lent. Thirdly, bailies come into play. A bailee is someone who temporarily takes possession of another person's property. Think of a parking valet or a storage company. They have an insurable interest in the items they handle because they'd be liable for damages while the items are in their care. The fourth way to acquire insurable interest is by being an agent. An agent is someone who has been given the authority to act on behalf of another person or company. If they have the power to buy, sell, or manage property, they have an insurable interest in that property. Lastly, executors and trustees also have insurable interest. Executors are people who are responsible for carrying out the terms of a will, while trustees manage property or assets for the benefit of others. In both cases, they have an insurable interest because they could be held financially responsible if they fail in their duties. Now, insurable interest can arise in 3 ways: at common law, under contract, and under statute. Common law insurable interest arises from legal relationships like marriage or parenthood. Contractual insurable interest arises from legally binding agreements like loans or leases. And statutory insurable interest arises from laws that specifically grant it, like insurance laws that allow you to insure your own life. In summary, insurable interest is a legal principle that ensures insurance remains a tool for managing risk rather than a game of chance. It can be acquired through ownership by being a mortgagor, a bailee, an agent, or an executor or trustee. It can arise at common law, under contract, or under statute. Understanding insurable interest is crucial because without it, an insurance policy is not valid. So next time you think about getting insured, remember to check if you have an insurable interest first.